Wow, the market is all in red. Should I buy? Yes, of course. In the sea of red, many stocks with good fundamentals are probably at a discount or undervalued. No, never catch a falling knife. The market is not doing well. You might make a loss. Do it when the market recovers. Do you hear these two voices in your head too? Well, neither of them are right nor wrong. There are more things to look into before buying the stock of a company, such as whether they have the right business model, right management, and right valuation versus price. Do you know how to determine whether the company passes these three criteria? Well, you're just in luck. I've been sharing with many like-minded people just like you, looking to kickstart their investing journey. And here is a clip of it. Check it out.
3R concept. In V College, we learn this. We only invest in stocks that meet the 3R. Right business model, right management, at the right valuation versus the price. Now, the first thing, when we want to invest in a business, do we want the business to make money or lose money? You want companies that make money. And how do you know which companies make money, which companies lose money? First rule of thumb, invest within your circle of competence. Invest in the stock that you know they are going to make money. There are so many businesses out there. There are more than 50 over 1,000 stocks in the world for you to invest. You definitely would know something, especially in the V College. I believe many of our graduates have heard many of the case studies that we have shared, and they have made hundreds to thousands of % of return. That's the reason why I published 2 books. One is called Value Investing for Women in 2012. The other one is called Invest Like Buffett for Parents in 2017. Now, why is it that I wrote the books for parents? Is because I hit the painful age called 40s in the mid 2010, and the 40s, 50s, I must say, in whichever country that you are in, is quite a painful age. Not especially that you mentioned we grow old, but we are at a sandwich group whereby we have our parents to support, our children to support, and who are the income earners? Us. But at this time, especially during the COVID situation, when companies get disrupted because of the COVID situation, companies need to cut costs and they need to have a retrenchment, layoff. Who goes first? The 40s and the 50s. When I wrote this book, it's because a few of my friends come to me and said, you know what, Pauline, I got retrenched. And they are engineers, accountants. They have been like what Jack's parents have been telling them, like my parents have been telling me, study hard, work hard. In the end, life still becomes hard. That's why I asked them, guys, why didn't you invest in the first place? They will tell me, you know what? I'm a parent. I'm very busy. I've got no time. And my word to them is this. I'm sorry. Okay. Please do not use busyness as an excuse for your financial irresponsibility. Ouch. Okay, I know these words are hurtful, but I'm going to repeat them again. Please do not use busyness as an excuse for your financial irresponsibility. Why? Because as parents, we have that responsibility, right? To support the old and the young, and we can't afford not to have income. Do you know how risky is that to just rely on one source of income? How about getting multiple sources of income? You don't even need to spend a lot of time in front of the screen. I never do that. All right. I'm a busy mother of 2. So I'm going to show you. You do not need to really time the market, okay? If you have a right system. So I'm going to show you, even if you invest at so-called the wrong time, when the stock market is at a high, you still make money. Have you heard of this stock called Nestle? I mean, you definitely as parents or any one of you would have heard of Nestle, this brand, right? Do you know it's a listed company in Malaysia, in India, in US, regardless which market you go to, you can buy into Nestle, the stock. Imagine if you do that in July 2007, 1 year before the subprime credit crisis. You didn't time the market, you bought at a high, Yet, if you keep this stock for 10 years, you are going to make near to a 400% return just by buying to the stock, taking care of your children, and sleep soundly at night. The other one, Dutch lady, they sell milk powder. Children, babies need to drink milk, near to about 500% return. Carter's Inc. Many of you would have heard of their clothes. Oshkosh B'gosh, Carter's, one of the biggest brand. Johnson & Johnson, that's not unfamiliar. Pigeon selling the milk bottles, the pacifier. You know what? I'm not even talking about technology stocks, I'm not even talking about tech stocks. Yet all these companies are fetching us 20 over percent per year return. I know when I was showing you the retirement calculator, many of you are questioning me. Pauline, it's not feasible. We can't get a 20% per year. You know what? Just this portfolio not only gave you a 20% per year return. Now, value investors like us, we make money two ways. We make money first from capital appreciation. Second, from this thing called passive income dividends. On top of the capital appreciation, these companies are giving you dividends ranging from 7% all the way to 20 over percent. That's much more than a 20% per year return. Your next question would be, Pauline, how do we know this stocks the share price keep going up? Just take down this four-letter word called moat. M-O-A-T, moat. Now, what is a moat? A moat is the water surrounding the castle. Okay, yeah, do you see this picture over here? It's the water surrounding the castle. What is it for? It's for protection. So in companies, we need to have this thing called the competitive advantage. And at this juncture, I'm going to share with you a stock. I know many of you would not have heard of this before. I will not invest into this industry called the international airline industry. Not even SIA shares, not even Air Asia shares. I'm sorry. I know Singaporeans, Malaysians love these two shares, but I won't invest. Why? Because these two companies has no moat at all. Why do I say so? Imagine you talk about Nestle, Dutch lady, you buy into Milo, Nescafe, milk powder. Do you realize their prices keep going up due to this thing called inflation? But over the years, there is one thing that the prices never go up. It keeps coming down. It's called the air tickets. Yeah, because now everyone can fly. So air tickets get cheaper and cheaper because of the competitiveness. Second thing, their risk is very high. COVID, they can't fly. 2 years ago, Hong Kong, there's a riot, they can't fly. Bad weather, they can't fly. Touch wood, sometimes they meet with accidents. There are lots of compensation. That's the reason why I do not like high risk and low returns company. Now, with this, you will realize as compared to Nestle, imagine now, even in COVID situation, do you use Nestle products? Ask yourself, is it within a circle of competence? And third question we ask is, 5 to 10 years down the road, would this company still be around? Why? Because we do not want to invest in a company called Kodak. Do you remember Kodak? What do they sell? Film. Who still use film? We use digital camera. We don't even use digital camera anymore. What do we use? We use our phone, and the quality is so much better right now, right? So this is where you got to ask yourself this question. 5 to 10 years down the road, would this company still be around as compared to, let's say, Nestle? Now, I want to say this. Nothing is 100% guaranteed, but at least we know this. The chances are high. Right? So this is where you will realize that we know about the business model. The next thing is, as the business model is good, the company is growing, their revenue keeps growing. Is the management doing a good job? The answer is absolute yes. But it does not mean we straight away jump in to buy the share, because we need the third R called the right valuation versus the price. Now, assuming you know how to calculate the valuation, and right now we have scenario one. The valuation calculator for this stock that's growing with a good management right now is worth $1.50 per share. That's the valuation that you have calculated. But the share price right now is $2. And my question to you would be, would you pay $2 for something that's worth $1.50? This is where my answer most likely would be a no. As I said, there are exceptional cases. The answer is yes. Okay, the answer is yes, but rarely. Why? Because there are always scenario two whereby you find a business model with a good management and the valuation calculated to be $1.50, yet the share price is only $1, right? So this is where you will realize what would your answer be? It's a hell yes, right? Yeah, absolutely yes, because it meets what we call the 3R. So invest only when 3R meet.
So now that you know the framework that I use to invest safely and sleep soundly at night, you need to know how to apply them. Let's translate our knowledge into action together. Click on the link below to attend our free 2-hour webinar where we'll share more tips on investing, what else to look out for, and we'll even go through case studies together for you to apply what you have learned. If you have enjoyed the video so far and would like to learn more about investing, don't forget to hit that like button and subscribe for more juicy content. Looking forward to seeing you soon. And last but not least, stay safe.